Imagine a company selling daily use FMCG products for food, staples, essential, yet default on its debt. That's exactly what happened with Future Consumer Limited in February 2024. And this case matters because it highlights how credit risk actually plays out an important role in Indian corporate bond market. Future Consumer Limited is the FMCG arm of the Future Group. It issued unsecured, non-convertible debentures or NCDs to raise funds for working capital and expansion. These instruments were held by investors who expected stable cash flow from a consumer business. However, due to prolonged financial stress, the company does not able to meet its obligations in February 2024.
So let now understand what actually went wrong in the case of Future Consumer Limited. First is that Future's consumer operating cash flow weakened significantly. The company was heavily dependent on the Future Group's retail ecosystem, especially Future Retails, which itself was under solvency stress. Second one is that the group level convenience played a major role here. When Future Retail collapsed, supplier payments were delayed and inventories piled up and receivables stretched, directly hurting to the future consumers liquidity. Third one is the company had high leverage and dependent on refinancing. Once credit rating were downgraded, the access to the fresh funding dried up. So, as shown in our timeline, financial stress kept building by 2022 onwards, and by February 2024, the company missed its non convertible debentures payment, leading to the defaults.
From a fixed income point of view, the real danger here was not sudden, it was slowly building. This case clearly demonstrates credit risk, which means the risk that a borrower may not repay its debt. In finance, we measure this risk using something called the probability of default, or so to say, PD. Even though Future Consumer Limited operated in the FMCG segment, which appears quite stable, its ability to repay bonds depended entirely on cash flows and not on brand visibility. As operating cash flows weakened and group level stress increased, the probability of default rose sharply, making the bonds fundamentally riskier. This shows that credit risk is not just about one company, but also about group exposure and structural dependence. The second important concept is credit spread behavior and credit rating actions. So, a credit spread is nothing, it is the extra return investors demands over a government bond to compensate for default risk, which is quite clearly shown in this picture, like how a extra return investment demands over this government bond. As risk increased, bond prices fell and yields rose, which means credit spreads widened significantly. At the same time, rating agencies took rating actions, progressively downgrading the instruments and eventually marking them as default grade.
So, let's discuss about the impact, recommendation, and conclusion. So, first we will see the impact. The default had multiple impacts. Debt investors faced capital losses, mutual funds had to mark down their holdings, and recovery become uncertain and dependent on legal resolutions. At a broader level, this default weakened confidence in mid rated Indian corporate bonds and reinforced the importance of credit due diligence. Now we will see recommendation. From an issuer's perspective, company must reduce group dependency and maintain adequate liquidity buffers for debt service. From an investor perspective, yield should never be chased without understanding cash flow sustainability and group risk. From market and regulatory perspective, strong group level disclosures and early warning mechanisms are essential. Now we will conclude that to conclude the future consumer NCD default remained as that in fixed income investment cash flow discipline matters more than brand strength.